One of the hardest elements for students to recognise in the business studies course is that cash is not a substitute word for profit, and actually there's a firm distinction between them, and you must recognise when you're allowed to use the word cash and when you're allowed to use the word profit. So you've got to try and have something in your mind to think, when I talk about cash flow, using the words surpluses or deficits, and then when I talk about profit, the other option is loss. And remember that you can talk about the word profitability as a separate idea, and that's the ability or the efficiency of a business to generate profit over time. So, in an exam, if you're able to understand the difference between cash flow and profit, you'll get better, if not good, analysis and application. So it's important to recognise that many profitable businesses can go under because they run out of cash. So if you look at many of the businesses that have gone into liquidation over the last 5 or 6 years, it's not because they weren't a profitable business, it's because they had some outstanding bills and they didn't have any cash in order to pay this. So, how can we get in our mind the distinction between cash and profit? So, when we did cash flow forecasting and we looked at the cash cycle, I used words like the cash inflow and the cash outflow. So it's to talk about when cash either enters or leaves the business. Now you have to remember, not all businesses operate on a cash basis. Some businesses will receive credit from their suppliers, so the ability to delay the payment, but also some businesses will delay when customers have to pay them. Whereas if we think back to a lesson before that, we had an entirely different formula for the profit calculation, and that was our total sales revenue minus our total costs. So I've made an important note here. It's irrelevant if you sell or purchase on credit or cash. It's just to acknowledge the fact sales have taken place or purchases have taken place, or any of the costs that you would have to pay that encompass fixed and variable costs. So we're going to look at some examples here so that you can see the difference. So I'm going to encourage you, I'm going to draw a little line down the middle of my page and I'm going to say, I'm going to try and document this business transaction, and on the left hand side we'll look at cash and on the right hand side we'll look at profit. So it says, let's buy raw materials and pay in cash for each month £100 at the same time, and we sell our goods for cash £400. So if you remember the layout of the cash flow forecast, on the top we'd have cash in, then we'd have cash out, and we can have the net cash flow at the bottom. Okay? And in January, let's say, we sold, so sales of our items, sales here, and we're making these sales in January, so we have £200. So if that was all of the transaction, then in January our net cash flow would be a positive cash surplus of £200, cash in minus cash out. You didn't have any cash out in January. So our opening balance in February would be a positive cash surplus of £200. We didn't make any sales in February. However, we had this credit bill to pay, So our net cash flow now is 200 minus 250, which means I'm now overdrawn by £50 in February to carry forward as my opening balance for March. So you can see we had one positive surplus month, and now we suddenly have cash difficulties because there is cash deficit £50. I would have to consider how I was going to cover that. So if we look at profit then, so remember, profit is just the formula sales revenue minus total costs. It has nothing to do with when bills are paid. So we made £200 of revenue and we paid £250 in costs. So that would be a £50 loss that would be recorded straight away. Now, so if you look, in January, this business looks as if it's doing quite well because it has £200 of cash in the bank. Yet, it is not a profitable business. It is a loss-making business because it incurred a loss of £50. If we look at a third example then, so we've been offered a special deal. If you buy the goods £500 cash, we can then sell them to a customer, but we have to give 2 months credit. Okay, so if we look at our cash, so I'll write the same January, February, March, just so you get the idea over time. Then we'll have our cash out and we'll have our net cash flow. So we have to buy the goods £50 cash. So straight away in January, I'm going to have £500 in cash out. We then sell them to a customer, but we have to give 2 months credit. So that actually says sold them in January, but don't actually get the money for them until March. So if we were just to assume those transactions, the net cash flow in January would be a £500 deficit. So in February, because we didn't trade any further, we would still have this £5,000 deficit. It's really bad news for our business. And it's only in March, when we get that money in from the credit sales, based on the fact that the customer is a good quality customer, and so the net cash flow at the end of March would have a cash surplus of £1,500. So if we move on to the profit then, our formula, sales revenue minus total costs. So we sold them for £2,000. It cost us £500. Here's a business that looks really profitable. It's £1,500 in profit, but yet we already know when we look at the cash sales of it, the cash element, that in January and February this business is overdrawn by £500 and would have to satisfy the criteria to get some extra funding for that, likely to be a bank overdraft. So, if we consider some of the other reasons that profit could be different from cash, profitable firms may be short on cash if they've built up a stock level, so our purchases goes up, but that doesn't necessarily mean that we'll be able to sell them straight away. But because you don't want to miss out on the opportunity if a customer comes along, you will always have some cash tied up in our stock. Notably, if the firm sells their own credit. So remember, that's when we give our customers, you buy now, you pay later, but then we have to go chasing up our customers, and not all of them will be good customers and pay when it's necessary. Also, if a firm has used its profits to pay a dividend or to repay a long-term loan, the firm may be short of cash because each of those will give out cash elements. Another example that you could add on to the bottom of this is if a business buys a capital item, so if you go out and buy a piece of machinery or some equipment and you pay cash, that would be a drain on your cash supplies. However, it wouldn't have any impact at all on the profitability of the firm in the short term. So I want you to look now. I believe that you have this case study in the pale blue book. You don't necessarily have to write the answers in the pale blue. There is space on the worksheet for you to type in the answers, but either one, I must see the answers. So the 3 questions that you've got to tackle for ACT, there's a calculation at the beginning. So how profitable is the house extension and conservatory? So remember the formula for profit. You should always be encouraged to write that first. Total sales revenue minus total costs. So using the example above, so look at the case study, briefly explain how ACT could encounter cash flow problems. Do they have to pay out any money? They don't get any money in for a while. The third and final question then says, what method should they use to manage its cash flow during the 7 months building period? I really would like you to consider 2 possible ways that they could raise finance, and this would be a good opportunity for you to go back to Bus 1 content and look at the raising finance methods. Alternatively, you could turn to the front of the first Bus 2 booklet, and remember there's improving cash flow, and it's one of the topics there. Okay, there are 3 questions and you must record the answer on the quiz sheet. Please show some work. Once you've finished all of these, that's the end to the presentation.